Maguire, Chief Economist, South Asia at ASEAN and Pacific at ANZ, joins in. Glenn, so great having you with us on the show. Now, to start off with, just going through what, some of the predictions that have come out from your reports, it's, a shift in global finance with the fulcrum shifting in favor of Asia. Now, a lot will argue that in the current stage of development, the momentum might not really be in favor of what you've prophesized because much of Asia is currently in transition politically as well as economically. So how would you justify that argument?
Look, I think what we are seeing is in the post-crisis period, the economic centre of weight is gradually shifting towards Asia. And what we're arguing at ANZ in the report we just released, Caged Tiger, is that Asia needs to more autonomously finance its own economic outlook and its own investment decisions, rather than the existing model, which is still largely sending high-quality savings to the US and Europe and having these intermediated and then sent back to the region. We're arguing that the region should autonomously grow these own savings itself, but obviously one of the dynamics that you need to see for that is deeper and more liquid markets within the region. So I totally accept your point that, as we're still moving through developmental stages in some of these economies, there is potentially a risk of capital flight, perhaps as we move closer to capital account liberalisation. But the key finding we had of the report was that no economy that is developing has been able to successfully transit from developing to middle income to high income without successfully harnessing the power of finance for growth. And as the global economy, particularly the old world economies, the US and Europe, find their banking sectors restrained by Basel III, by regulatory oversight measures such as Dodd-Frank, then, it really is up to Asia, I think, to more autonomously deepen its own financial markets so that growth can be financed over the next 20 to 25 years, right into the middle of the Asia century.
And I think that would probably mean good growth for some of the large companies in Asia as well. But, I just want to dwell upon a point on the macro before we come to India in particular. You speak about Asian savings being trapped in the US Treasury as well. And you spoke about flight of capital. Now, a lot of us in India get worried by two things. One, what could higher commodity prices, particularly crude, do to capital flight into India or capital into India? And two, what happens if indeed the US yields were to nudge the 3% or higher marks? What happens then? Because September last year was fairly bad for emerging markets in general and India in particular. What are your views on the same?
Look, I think last year when Ben Bernanke put the idea of taper out there, it was unexpected. The markets weren't thinking the Fed would move that quickly. And it's important to recognise that since that period, we've effectively seen a 2-year repricing of Indian and Asian assets relative to the US. And how that has come about by exchange rates, which automatically reprice assets in the international marketplace. So that's been one of the key developments. I think the fact that we've seen this automatic repricing of Asian and Indian assets relative to the US, plus the fact that Janet Yellen is signalling a more gradual approach to the Fed normalisation, suggests that it will be quite well handled by India and the emerging markets. The other key difference is India and Indonesia, the two economies within Asia that were considered part of the Fragile Five, have made significant progress in stabilising their so-called twin deficits, the current account deficit and the budget deficit. And these are what needs to be financed in the international markets and require capital inflow. And India has significantly reduced both the current account deficit and the budget deficit, and the outlook is that both will continue to improve, particularly the budget deficit, which is likely to be narrowing over the next 2 to 3 years. So we think in addition to this repricing of assets, the economy is in a much better position from a twin deficit perspective to be able to withstand the normalisation of rates. Now, what will be important for Janet Yellen and the Fed is the signals when the first rate hikes start. And we think if Yellen signals a gradual normalisation process, then we're not going to see a significant steepening of the US Treasury curve and US 10-year yields rising much above 3%. In fact, we're probably thinking they're going to rise to around 3.1%. So I think the normalisation of the rate structure is manageable for Asia and India, but more importantly, the normalization of the US rate structure, which is coming about from an improvement in the US economy, is a positive for Asia and India and the global economic outlook.
And Glenn, now I want to shift focus, to the overall banking system as a whole. And we do have the RBI's fangs, which are sunk fairly deep into the Indian banking system. But despite that, there's a huge crisis of bad loans that we face. What do you think is really the cause for this? And do you think that in the current, how do you see, things turning around when it comes to this phenomenon? Is it just cyclical or structural in your view?
Look, I think it's a little bit of both. I think the global economy is coming out of a period when interest rates have been low and where liquidity has been generous. And there have been a number of economies, including China and India, where there has been too much lending, perhaps for projects and products, which will not generate an economic rent or an economic return as liquidity is reduced and the global interest rate cycle moves higher. But India isn't alone in that period, and I think it's been one of the consequences of an extended period of ultra-low monetary policy in the developed economies and too much liquidity flowing into the emerging markets. But the key underlying or the denominator for non-performing loans is the actual rate of GDP growth. And India is likely to be making sure and steady improvement on GDP. And we're forecasting growth is probably likely to continue strengthening from around 5.5% to 6% towards even 6.2%, 6.5% by the end of next year. Now, that's not a return to the very high levels of growth we've seen in recent years, but it is a level of growth that should be enabling an improvement in liquidity, in operating conditions. The rupee still remains at a competitive level, and we think a return to solid, broader-based macroeconomic growth is going to be one of the key ingredients in helping to resolve non-performing loans and, in fact, return some marginal projects to profitability.
Very interesting. So, how does India stack up? I'm also asking this question from what you believe could happen to the Asian equities in general, because I believe you said that the market cap of Asian equities could explode from $9 trillion currently to $55 trillion. If indeed the Indian GDP could go or claw its way back to 6.5% in the next 2-3 years, what happens to Indian equities?
Look, I think the overall medium-term outlook for Indian equities and for Asian equities is very, very constructive. And what we've argued in our Caged Tiger report is that for Asia's financial systems to develop, one, they need to become larger and deeper, but two, you need to see a shift away from still bank-centric dominated financial systems, and the fact we have a non-performing loan problem is going to aid in that process, more towards an equal role in financing economic activity by the equity markets and the debt markets. Now, debt markets typically take longer to develop, particularly private debt markets, so we think the long-term financing role of many companies in India is increasingly going to be sourced from the capital markets, the equity market, via issuing stock, and we're probably going to see foreign participation in that be quite high, particularly as India returns to a more sustainable and positive growth trajectory in the coming years. So I think the medium-term outlook is very, very constructive. We think the absolute depth of India's equity markets is going to grow and grow significantly. From a shorter-term perspective, the economic data globally is turning up, and I don't think India is going to be immune from that. I think we are on the cusp of an inflection point upwards in production and in exports, and I think some of the more global-facing cyclical stocks of the Indian bourse are going to benefit from that.
The danger, what's the danger to equity flows or fund flows to India? Could it be outperformance, significant outperformance by some of the other Asian peers, or could there be something within India that could drive investors away?
Look, I don't think any risk is going to come internally focused. And I think one of the key dynamics we need to focus on is that many other Asian economies, particularly the ASEAN economies and the Mekong economies, are starting to attract stronger FDI inflows. Now, why this is important is Japan is starting to shift its production bases more away from China and Thailand into the ASEAN and the Mekong. China is also starting to deindustrialize at a fairly early stage in its growth profile and shifting its production networks into lower labour cost economies. So we see FDI inflows emerging for some Asian economies as a more secure medium-term source of financing, and they're replacing the shorter-term volatile portfolio inflows. In India, there's still a reliance a little bit too much on portfolio inflows as opposed to foreign direct investment inflows. And I think a faster acceleration of FDI reform, a more transparent FDI regime and the lifting of caps in FDI across key sectors clearly would make India more attractive in attracting these more stable, durable, medium-term foreign direct investment inflows. So perhaps the risk is not one that's generated endogenously within the Indian economy. It's perhaps that the ASEAN economies, which have more open, transparent and flexible FDI regimes, are going to attract more stable and secure medium-term financing.
Yes, and hopefully the government has been making the right noises, moving in that direction and living up to their promise with respect to opening up of FDI in various sectors. But a final call with respect to, from a consumer point of view, the banking space, and in terms of, our penetration into rural India, we still seem to be lagging. Do you think that, we will continue to remain and lag behind some of the other Asian peers when it comes to this?
Look, I think this is one of the key challenges for India. It's one of Asia's largest economies on basically any metric you can use: GDP, population, geographical size. And to get an even distribution of banking services within the economy is a key challenge. China has faced exactly that problem. The big four banks in China have access to a retail branch network. They're able to raise money for lending from deposits. The smaller banks don't have that, so they've had to offer the more innovative wealth management products to raise money, and that's led to some fragilities in the Chinese banking system. So I think an even distribution of banking geographically is vitally important, and it's one of the key metrics we look at is how easy finance is accessed or accessible across the economy. So I think one of the challenges for India is to embrace technology and essentially to leapfrog the branch network structure and move to mobile telephone banking or internet banking technology to allow an equitable and even access across the economy. So I think that's one key area that can be accelerated in India and will lead to a more even distribution of financial services. And I think the China example shows how important it is that everybody across a very large economy like India does have access to these banking services that allow them to have precautionary savings, but also to access future income via mechanisms such as credit. So that would be a key recommendation we'd also make for India. Harnessing technology for improving banking delivery.